There has been so much talk about the inverted yield curve lately, and for good reason. Ever since its existence in 1976, it has predicted every single recession. We can see here the inversion that led to the 2008 recession, and we can also see here the inversion that led to the 2020 recession, and now the most recent inversion that analysts are predicting will trigger the greatest recession we have ever seen is set to trigger sometime in by the end of 2025 or 2026, but definitely by 2026. And because of how deep this inversion is, they are predicting this inversion will be greater than the recession we had during the Great Depression. So this is not your typical bubble either. I mean, it's the entire U.S. economy. So make sure you watch this video all the way to the end because not only am I going to give you guys, all the bad news, but I'm also going to give you guys a lot of good information that can help you have some massive profits. For those of you who this is the first video of mine that you are seeing, my name is Jeremy Dancer. I am a forex trader, hedge fund manager, and forex coach. If you would like to join my program, check out the link below. And thanks for checking out this video. Make sure you like and subscribe and ask questions if you have questions. Email and Facebook Messenger is by far the best way to reach me. So the U.S. economy has basically been pushed to its max with consumer debt, auto loans, home loans, a labor market that has collapsed, and a stock market that is drastically inflated. The US dollar has also lost global demand, and even America's largest banks are facing liquidity issues. On October 31, a couple weeks ago, America's banks received the largest bailout since 2020 to address their liquidity shortages. And this was not a small amount either. In total, it was $50 billion. And they broke the 50 billion into two different operations. The first operation was roughly 20.35 billion, and then the second operation was almost 30 billion. So that should be pretty alarming for a lot of us that they had to get this much money, not for investments like they normally do, because banks normally go to the repo facility to get funds because the interest rate is much lower than if they go to private firms. So they go to the Fed all the time for money. But this was like one of the first times in recent years that they had to go to the Fed because they were just running out of money. So, what does it mean when these banks are having liquidity issues and they run the same problems that Silicon Valley Bank had that bank go out of business? So, guys, this is a massive bubble that is unfolding. All right. So, to understand the mother of all bubbles, you must first understand the role derivatives play. And then, when I explain the inverted yield curve, everything is going to make sense. So, when we had the recession back in 2008, the derivatives market was only $60 trillion, right? And now that same market globally is roughly $600 trillion. Of that 600 trillion, 200 to 220 trillion is in the US alone. Now, that's not even the crazy part. The crazy part is of that 200 to 220 trillion dollars in derivatives, 87% of that market is owned by just three banks. That is JP Morgan Chase, Bank of America, and Citigroup. If you're not sure what a derivative by definition is a financial contract whose value comes from or is derived from the value of another asset called the underlying asset. The underlying asset could be a stock, a bond, a commodity like oil or gold. It can be a currency, interest rate, or even an index like the S&P 500. So the derivative does not have to have value on its own. Its price depends on the price of something else, and that something else doesn't have to have value on its own either. In other words, banks can speculate the value of assets they want to use as collateral, for example, real estate and currencies. So a bank can say, "Hey, I got 100 million in real estate that's worth today that I want to use collateral on a loan for $1 billion, for example." So we all know the value of real estate changes, all the time. Real estate doesn't stay the same all the time. In short, that's kind of how a derivative works. And I'm going to explain this in several different perspectives so that you guys can fully understand this as well. In this example, we're going to look at how banks use derivatives for other derivatives. And then I'll give you guys an example of what a default looks like. All right. So first, Bank A puts up $1 million as collateral for a contract worth 100 million to Bank B. We're just using this as an example, guys. Don't take these as real numbers. If Bank A doesn't have 1 million to put up for collateral, but has 100 million in real estate, Bank B can accept that instead of the 1 million in cash. If Bank B determines the real estate is no longer worth 100 million to, let's say, 50 million, then Bank A goes to Bank C for $50 million in capital and uses the contract it has with Bank B as collateral and now has the capital to make good on the contract with Bank B. Banks have thousands of contracts like this, which is how they have $1 trillion market caps. Okay, so if this sounds crazy to you, it's because it is crazy. And these banks are going crazy with it. All right. So now let's look at what happens in a default situation. Okay, sticking with the same numbers, Bank A has a contract with Bank B. Bank A buys a contract from Bank B worth $100 million, but only puts up 1 million as collateral. The contract goes in the wrong direction for Bank A. In that case, the $1 million in collateral is wiped out. But if the bank, but if the contract exceeds the 1 million collateral, Bank A can owe money to Bank B that it doesn't have. So now both banks are at risk for losses. If Bank B has a contract with Bank C, it runs the risk of owing money it can't pay, and so on. So, in the event banks risk solvency, they go to the Fed, and the Fed essentially bails them out. As if just one of these banks collapses, there is a ripple effect to the other banks, and the entire banking system fails. So, this brings me back to what happened on October 31st when the banks had to be bailed out. You know, currently, all derivative markets are stressed. US banks have exposure between 200 to 220 trillion dollars, while globally the exposure is 600 trillion. In the event the derivatives market collapses, it is too big for the Fed to save, as printing 200 to 600 trillion would cause serious problems for the US dollar. And that's when things gets really crazy. So when I say that there is a bubble, there is a massive bubble that is exploding. And the crazy thing is, these banks were actually managing it all. But the problem happened when Trump started doing a bunch of uncertain things that created a lot of chaos in the markets. No one expected Trump to have a trade war with every country. No one expected inflation to get as high as it did. No one expected the AI bubble. No one expected the labor market to collapse. No one expected the US dollar to lose global demand. Even central banks started moving their money out of US dollars and into euros. And now you have this market where literally everything is uncertain. We don't know the future of the auto loan market. We don't know the future of home loans, consumer debt. We don't know the future about everything. But all these banks have used all of these different things as collateral for other derivative contracts. And when this all starts crashing, there's going to be thousands of contracts that a lot of these banks are going to be negative on, that they can't pay other banks. And when you have, just three banks in the US that own 87% of the market, that is some scary stuff. Okay, so now that we have some context behind the derivatives aspect of everything, that will trigger the bubble. Now let's look and see what the inverted yield is telling us. All right, so all of this, by the way, is available to the public. I think only hedge funds and financial analysts and banks probably look at this stuff, but I think the general public should really start paying attention to these types of things as well. All right, so I want to give you guys, a little bit of history here, just so you guys can see the pattern. So I'm going to change the date, and we're going to look at what happened in 2008. So we'll start here, and let's change this to. All right. So this is close enough. Okay, so we can see here the inversion started on the 9th of February, or February 6th of 2006. And we can kind of see there's a little bit of funny business, but the inversion wasn't that deep. So if we use February 3rd of 2006 and we go to, let's see, June 4th of 2007. The inversion lasted for a while, but it wasn't that deep, right? So when you see something like this, you would think the recession shouldn't be that long. Now, keep in mind, typically, once the inversion has been broken, we see a recession 12 to 27 months later. Now, this was a very unique situation in that it didn't take 12 months, right? So it broke the inversion, let's say June 8th of 2007, and then July, August, September, October, November, December. So, it only took like 5 or 6 months for us to have the recession, right? So this was a unique situation. But look at how big the recession was, just from an inversion that was this, small, right? It wasn't really that deep. All right. So now let's look at what happened in 2020. So you always want to look at the months that led up to it, and we'll do 2022. Okay. So we can see this inversion was like, August 23rd, maybe like a month or so. It was a very small inversion, and then we had a very small recession. Okay. So now let's understand why in the world is everybody freaking out about the current one, right? So let's just change this to 2020. Let's change this to 2025. All right. So now that we have some context behind this stuff, look at the difference, right? I mean, this is like terrifying. If those small inversions was enough to trigger, recessions, then what is this? We haven't seen an inversion like this, since forever. Now, because this goes back to 1976, we can't use this to track the Great Depression, but I have a strong feeling if we did have this data available, it would probably be something similar. So banks started freaking out when they saw this right here, because now it's like, you know, we're seeing some type of consolidation and we're waiting for a breakout. And we are already in that 12 to 27 month window, right? Because we broke the inversion, let's see, right around here on September 3rd of 2024 was when we broke the inversion. So 12 months from that is September 3rd of 2025. So we're already 12 months in to where at any moment we can see that recession start. And some people are saying by the end of 2025. Some people are expecting the recession in the first or second quarter of 2026. But the one thing that everyone is agreement on is that there will be a recession. It will be worse than at least 2008 and most likely the 1929 Great Depression. And it's going to be, obviously bad. So when I look at stuff like this, I start thinking, okay, you know what? How do I prepare for a recession of this magnitude? Because the stock market's not safe, the U.S. dollar is not safe. What is safe? You're seeing a lot of people say, oh, you know what? Gold, silver, Bitcoin, and all these different things, ETFs, you name it. All right. So what I want to do next is I want to look at gold, so that you guys can have a perspective as to why gold may not be the direction you want to go in. Okay. If you have made it this far in the video, please make sure you like and subscribe if you haven't. It means a lot. And I appreciate you for sticking with me this long. We're almost done. I just want to touch on a few things and we'll be good to go. All right. I appreciate you guys. All right. So this right here is my view on gold. All right. So ever since gold broke consolidation from 3,500, it went on a massive bull run, right? And this is what concerns me about gold. When it made a all-time high of almost 4,400, it had a sharp drop. Okay. I like to see consolidation when a price or when a currency makes an all-time high. So since there was no consolidation, what I am seeing with gold is that we are in correction territory. Now, today, gold did get a nice jump. So it broke this bearish trend that it was having. But I think part of this is because of what is going on with the U.S. Government shutdown. Uh, there's, supposedly the Democrats and Republicans have reached a deal, but it hasn't passed yet. So until that deal is official, um, people are probably, putting money in gold, and my guess is, this move is going to make a correction. Because before that happened, we can see here that the candles were below the EMA lines in the GDAX indicator. So GDAX is very good for identifying bullish and bearish trends. And it has these two EMA lines. So when you see the candles above the EMA lines, that's a confirmation of a bullish trend. And when you see the candles below the EMA lines, that's a confirmation of a bearish trend. So we can see that the candles were staying below those EMA lines. And then we had some breaking news with the US government shutdown. And that's why we see this bullish candle on gold. But I don't think this is sustainable. All right. If you look at the history on how gold moves, and by the way, I am a active trader of gold. I trade gold relentlessly. I probably do hundreds of trades every week on gold. Okay, so I follow this very deeply. So if you look at the first consolidation period, this is what I like to see. Gold made an all-time high, and then it did drop, but it stayed within a nice range. So you can see this consolidation, and this makes it look stable. We don't see that level of stability with gold on its current prices. We see a high, we see a low, we see a lower low, and we also see lower highs. So even though gold made this nice jump, it's still below 41.58. And until gold can get over 4,200 and maintain that price, I would not put too much trust into gold. All right. What I do recommend every single person do, though, is buy XRP. All right. XRP is a beast. All right. XRP is expected to have 90% of all global transactions. And this month alone, we have about at least 10 ETFs that are expected to be launched. Many countries are also using XRP to back their treasuries. Okay, what we saw recently with Coinbase and other crypto brokers is that they have moved 90% of their supply of XRP only for their institutional traders. So, these are signs that banks are moving in this direction, right? So, if I were you, my recommendation would be to put your money in XRP. You probably can't go wrong with Bitcoin. Another favorite of mine is also Litecoin. This is a very stable crypto coin, and Litecoin is a better version of Bitcoin. The only reason why it hasn't followed the same price pattern is because the supply is like 3 or 4 times as large as Bitcoin. So it's going to take longer for it to move. But, there's some exciting stuff happening with Litecoin. Litecoin has been approved to be an ETF. Just like XRP, we're going to see a lot of institutional investment in Litecoin, and who knows, one day Litecoin might actually follow Bitcoin. Me personally, if I had tens of millions of dollars, maybe I would buy Bitcoin, but I want the best bang for my buck. And right now, the best bang for my buck is XRP because XRP is designed to reach $10,000. So if I can buy, XRP at $2.50, that makes a lot more sense than buying Bitcoin. Um, Litecoin is still relatively cheap. SHIB is very cheap. I don't know. I don't think SHIB can follow XRP. But just imagine if one day SHIB reaches $1. SHIB, Litecoin, and XRP, those are my three favorites. I think gold is risky. Uh, that's just my opinion. And, that's based on the charts. But if I can see gold maintain, 4150 to 4300 and then get back close to 4400, but I start seeing some consolidation at those higher price levels, then I might be convinced to buy gold as a way to hedge against the collapse. But right now, all the smart money, all the big money is pointing towards XRP. All right. Thank you for all the new subscribers. Thank you for checking out this video. If you are not part of an investment group, join mine. It's only $200 one time to join my program. You get my complete forex program. You get a Zoom meeting with me that's included, and if your account is big enough, I will even trade your account for you. And there's a lot of exciting things happening in my program. So definitely, if you're not part of mine, be part of something because you're going to need somebody who understands this stuff and lives it, breathes it, and stays on top of it so that when markets start changing, you can kind of see how you need to change as well and different investment ideas and trade ideas. All right. Thanks again for checking out this video. I appreciate all of you and take care, everyone. Happy Veterans Day for the veterans. I am a Navy veteran myself. Happy Thanksgiving to everybody else. If you celebrate Thanksgiving, and if I don't hear from you for the holidays, have a nice holiday as well. All right, take care, everybody, and I appreciate you.